So hello all my dearest students of CA Final Direct Tax from southern part of the India. I hope you all are doing good. So you all have been waiting for this particular revision video, and here we come with this revision video. That is one of the most important topic for your CA final exams for May 23 and November 23, that is non-resident taxation. So you all have been waiting for this topic since lot of days. So finally we have come up with this particular video. So without wasting any further time, let us start with the discussion of all the provisions which are relevant for the non-residents in this entire beautiful topic. Okay. So the first thing which we need to understand over here is the scope of total income. Who is liable for tax in India? The first thing you need to understand, there are three types of residents, that is resident and ordinary resident, resident and not ordinary resident, and non-resident. For resident and ordinary resident, world income is taxable. Whether the income is accrued in India, accrued outside India, received in India, received outside India, irrespective of the fact, that income is always taxable in the hands of the ordinary resident. What about not ordinary resident and NR? In case of not ordinary resident and NR, income which are accrued in India or which are received in India will be taxable. So income has to be either accrued in India or income has to be either received in India, then only it is taxable. Second, it means in these cases, that is in case of NOR and NR, income will not be taxable in India if it is accrued also outside India and it is received also outside India. Accrual also outside, receive also outside India, no taxability in case of NOR and NR. Then what is the difference between NOR and NR? The NOR and NR difference is only because of one point, and that is because of PGBP. That is, if the PGBP is done outside India, that is if the PGBP is accrued outside India, but it is controlled from India, it is accrued outside, controlled from India, then NOR will pay tax, NR will not pay tax. This is the only difference between what? Between NOR and NR. Rest of the items between NR and NOR are exactly same to each other. Okay. So now the first thing which we need to understand over here is the residential status of every person. So first of all, we'll try to understand the residential status of individual. An individual will become resident because of any of the two reasons. First, if he stays for 182 days or more in the current previous year, then he will become resident. Now, if he does not stay for 182 days, then there is one more condition which he has to fulfill. That is 60 days in the previous year and 365 days in the last 4 years. Now, if he fulfills any of the two conditions mentioned above, either 182 or 60 plus 365, then he will become resident. Okay. Now, how he will become ordinary resident? He will become ordinary resident. For becoming ordinary resident, he has to fulfill two additional conditions. First is, he has to be resident in at least 2 out of the last 10 years. Out of the last 10 years, he should be resident in at least 2 years. And in the last 7 years, he should be resident. He should be in India in the last 7 years for at least 730 days. So, if he wants to be ordinary resident, he has to fulfill this condition and this condition both. Then he will become what? Ordinary resident. Now, there are some exceptional assessees like. If there is an Indian citizen, condition number 1, who is living India during the previous year, condition number 2. How he is living? He is living as a crew member of Indian ship, or is living for the purpose of employment outside India. So, if there is an Indian citizen who is living India during the previous year as a crew member or for the purpose of employment outside India, then in that case, for him, the condition of 60 plus 365 is not applicable. Only 182 days condition is applicable in that case. Only 182 days condition. 60 plus 365 days condition is not applicable. Similarly, if there is a person of Indian origin or an Indian citizen. Sir, who is a person of Indian origin? A person of Indian origin means a person who was born in India, undivided India, or his parents were born in undivided India, or his maternal or paternal grandparents were born in undivided India. If anybody out of these people have born in undivided India, then that person will be called as what? Person of Indian origin. Now, this point is for people who are coming back to India. This point was people who are going from India. Now, this point is for people who are coming back to India. So, if there is an Indian citizen or a person of Indian origin who is visiting India, not permanently settling to India. If he is permanently settling to India, then for him these two conditions will be applicable. But if he is coming as a visit to India, then there are three possibilities over here. If he is coming for a visit for less than 120 days, that is 119, 118, 117, then he is always non-resident. If he is coming for 182, then he is always resident. Then he can also become ordinary. If he fulfills the two additional conditions, then he will become ordinary. So here there is a two possibility. He will either become resident and ordinary resident, or resident and not ordinary resident. So less than 120 days, always non-resident. 182 to more, always resident. Then there is a possibility ordinary, not ordinary. But if he comes in between, that is for 120 to 181 days, then there is a different possibility. Then he will always be NOR if he fulfills some condition. And if he does not fulfill the condition, then he will become NR. If he fulfills some condition, then he will be NOR. And if he does not fulfill the condition, then he will be NR. So what are the conditions that he has to fulfill? In the last 4 years, he has to stay in India for 365 days. And his income from Indian sources should exceed 15 lakh rupees. Other than foreign sources should exceed 15 lakh rupees. It means income from Indian sources should exceed what? 15 lakh rupees. Indian source will also include that PGVP which is accrued outside India but which is controlled from India. That profession which is done outside India but which is set up from India. Be very careful. Indian source will also include that PGVP which is accrued outside India but controlled from India. That profession which is conducted outside India but which is set up in India, that will also be part of Indian source only. So if these two conditions are fulfilled and if he stays for 120 days to 181 days, then he will be not ordinary resident. But if he does not fulfill any of the condition, then he will be satisfied. He will be called as what? Non-resident. So here there is only one possibility, non-resident. Here there is two possibility, ordinary, not ordinary. Here also there is no two possibility, either not ordinary resident or non-resident. Okay. So coming back to the discussion above, here there is one rule which is very, very important for us to understand. The government has brought one rule to clarify one very important thing, that if an Indian citizen is leaving India as a person of what? Crew member of an Indian ship, then how will the number of days will be calculated, whether he is in India or is outside India? So the government has said that if an Indian citizen who is going outside India in an Indian ship, in a foreign going ship, and he is a citizen of India, then the days entered in the continuous discharge certificate, the sign in when he was signed in the ship, so he has to sign a continuous discharge certificate, and when he will sign off, when he will come back to India, the captain will sign off that continuous discharge certificate. So that much period will be excluded as not part of India. Suppose 15th June 2022 was the date on which it was signed in the continuous discharge certificate, and 15th July is the date on which it was signed off in the continuous discharge certificate. So from 15 June 2022 to 15 July 2022, it will be considered that he was not a part of India. Okay, so this is what this provision wants to say. Now one last residential status point over here for individual, and that is the concept of what? Deemed resident. Now, who will be called as deemed resident? Deemed residents are those persons who are Indian citizen, again whose income from Indian sources are more than 15 lakh rupees. Indian citizen whose income from Indian sources is more than 15 lakh rupees, and he is not liable to tax in any other country in the entire world, in any other territory in the entire world, then the government of India says that you will be deemed to be resident in India. Check it please. Liable to tax means what? There is an income tax liability, and subsequently which has been exempted will also be considered as what? Will also be considered as liable to tax. Okay, so if there is a person to whom there is some income tax liability in say UK, and that government has exempted the law, exempted the tax on that person, that will also be called as what? Liable to tax. Okay, as per the income tax law. So this is what the residential status is all about of individual. Let's talk about the residential status of HUF. When an HUF will become resident? HUF will become resident if the control and management is wholly in India or it says partly in India, then the HUF will become resident. Is HUF also ordinary? Yes. If the Karta is a resident and ordinary resident, then HUF is also ordinary in resident and ordinary resident. What about partnership firm, LLP, AOP, BOI? Their residential status will be exactly same as what? HUF. Check it please. But just remember that there are only two kind of person who can be ordinary resident, and that is individual and HUF. Apart from individual and HUF, every other kind of person, whether company, LLP, firm, etc., will be either resident or either non-resident. Ordinary concept is only for individuals and HUF and not for anybody else. Okay. Now let's come to something very important for our exam. That is residential status of a company. When a company will become resident, that is very important. A company can become resident because of two reasons. First, if it is an Indian company, then it is always resident. Can a foreign company also become resident? Yes. If the place of effective management of that foreign company is in India in the current year, then that is also resident. What do I mean by place of effective management? There is a very simple definition given by the government. Place of effective management means a place where key management and commercial decisions necessary for the business are made. Now, is there any guideline given by CBDT to determine whether the place of effective management is in India or outside India? Yes, but that guideline is only applicable for companies having turnover greater than 15 crore rupees. If a company's turnover is less than or equal to 50 crore rupees, then this guideline is not applicable. This guideline is only applicable to companies having turnover more than 50 crore rupees. Now, what this guideline has to say? This guideline divides all the companies into two categories. First, a company whose ABOI, active business, is outside India. If the company's active business is outside India, then the poem is outside India. And if the poem is outside India, then this company is a non-resident, non-resident, non-resident. So let's find out when the active business will be outside India. So for that, you have to fulfill 4 conditions, and then 1 additional condition has to be fulfilled. Total 5 conditions have to be fulfilled if you want to make a company a non-resident in India. So what are the 5 conditions? We'll see one by one all of them. So if these 5 conditions are fulfilled, then the company will be said to be what? Non-resident, non-resident, non-resident. The active business will be outside India, outside India, outside India. But if even one of the condition is not fulfilled, then what to do? That we'll see after some time. Okay. So first, let's talk about ABOI. That is, if the active business is outside India. Let's talk about the first condition. The passive income should be less than equal to 50% of the total income. So your passive income should be 50% or less than 50% of your total income. Passive income includes what? Passive income includes 2 incomes. First, where you purchase and sell both to the associate enterprise, that will be considered as a passive income. For example, I purchased the goods from associate enterprise and sold to associate enterprise, that is a passive income. But if I purchase from associated and sold to non-associated, then it will not be called as a passive income. And if I purchase from non-associated and sold to associated, there also it will not be called as a passive income. Both purchase and sale has to be from and to associate enterprise. Second, royalty, capital gains, dividend, rent and interest. These 5 incomes will always be passive, 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 passive. But in case of interest, in case of money lending business like banking business, interest will not be considered as a passive income, but it will be considered as an active income, active income, active income. Okay. So this is the definition of passive income, and your passive income should be less than equal to 50% of your total income. Let's talk about the other items, other categories, other condition. Your assets situated in India should be less than 50% of total assets. So out of the total assets, your assets situated in India should be less than 50% of the total assets. How to value the asset? You can take the average at the beginning and at the end of the year of the assets if you want to take the value of the assets. Okay. Third, your employees situated in India and your employees resident in India should be less than 50% of your total employees. Suppose if you have 100 employees, your less than 50% employees should be resident in India and should be situated in India, then this condition will be fulfilled. So how to compute the employees count? Employees count will also be computed as per the average at the beginning, and at the end of the year you will compute the value of the employees. You will compute 1st April, 31st March, divide by 2, you will take the average and you will find out the employees. Okay. Employees will also include contractual person, very important person, very important point. This person is also included as a part of an employee. Employee will not only include what? Will not include a person who is a part of your payroll, but will also include a person who is a contractual person. Be very important, very, very important. Next, the employees which are situated in India or which are resident in India, the total payroll expense for those Indian employees should also be less than in amount. This point number 3 was number of employees. Point number 4 is regarding the amount, the expenditure which you incur on employees. So that employees which are situated in India or which are resident in India, that expenditure should also be less than what? Less than 50% of the total cost of your payroll. Okay. And last but not least, your majority of the board meetings have to be held outside India, and board should have the authority to take decisions of commercial and big decisions. So the board should have the authority to take decision. So majority of the board meetings have to be held out of India. So if there are 6 board meetings, 4 have to be held outside India. 10, then 6 have to be held outside India. Majority have to be held outside India. But if the holding company in India makes common policy for everyone, not specific to any particular company or any particular country, then it cannot be said that the board of directors does not have power. In that case, it's a common policy. No, but it is not forcing any particular company, and it is not enforcing any decisions on any entity. It's a common policy that they can do. There is nothing wrong in that. Okay. So if these 5 conditions are fulfilled, then the ABOI, active business, is outside India. If ABOI is outside India, poem is outside India, and if the poem is outside India, then the company will be said to be non-resident in India. So the data which we have taken over here, it has to be for how many years? If possible, you have to take the average of current year and the last 2 years if the data is given. If the 3 years period is not given, then you can take a shorter period also. There is nothing wrong in that. So if the current year 22-23 and the last 2 years data is given, then take the average and then find out all these things. If data is not given, then take the current year and last year. If that is not given, then take the current year data. That is also fine. Okay. Now, what about the companies who are other than ABOI, whose active business is not outside India? It means the companies who are violating either of these conditions, then in that case the government has given a theoretical discussion over here, whereby they have said that first of all identify the person who has the power to make a management and commercial decision, and then identify the place where such decisions are made, and the place where such decisions are made are more important than the place where such decisions are implemented. The place where decisions are implemented are not relevant. The place where such decisions are taken are important. For example, Mukesh Ambani sitting in Mumbai and taking a decision to start a plant in Sri Lanka, then the place of Mumbai is important because place decision is made in Mumbai. The place where decision is implemented, that is Sri Lanka, is not relevant. Okay. Now, apart from that, they have also given other guiding principle like. This is not the only guiding principle. Now they have given lot of guiding principle. One has to follow all of them to identify whether the poem is in India or not. Like if the location of the board meeting is in India or not. If the location of the board meetings are in India, then the poem can be considered to be set in India. Like if the board is delegating some of the authorities to some of the committees, like sometimes the board delegates some of the authorities to executive committee, remuneration committee, audit committee. So if that committee is taking commercial decision, then see where the members are based, where they develop and formulate key management and commercial decision, that place will be considered to be place of effective management. Location of head office can be considered to be a place of effective management. Director's residence can be considered to be a place of effective management. A person who has the authority to pass a circular resolution under Companies Act section 175 or round robin voting under section 175 of Companies Act, that can be considered as what? As a place of effective management. If the location of strategic shareholder, generally the location of shareholders is not important to determine the place of effective management, but the location of strategic shareholder are whom? Are those shareholders who are investing substantial amount in the company are considered to be a strategic shareholder. Generally, small shareholders are not relevant to determine the residential status or poem of any company, but the strategic shareholders can be important to determine the residential status or poem of the company. If all these factors are also not working, then the department has given some other secondary factors. Find out where the substantial activity of the company is carried out, or find out where the accounting records of the company is kept. Now, at the end, the government is saying ultimately the poem will be determined based on the facts and circumstances of every case. No single principle will be decided that just because the foreign company is owned by an Indian company, or just because the directors are residing in India, or just because the local management in India, or just because the license office in India of that company, then the poem will be in India. No single principle will be deciding that whether the poem is in India or poem is outside India. No single principle can decide that. Okay. Now, there is one procedure which the assessing officer has to follow if he wants to hold a company's poem in India. If the assessing officer wants to hold a company's poem in India, he has to follow a particular procedure. What is that procedure? If the AO wants to initiate what? The proceeding to hold a foreign company's poem to be in India, then he should take prior approval of what? CIT. He should take what? Prior approval of the CIT. So, if the AO wants to hold the poem of a foreign company in India, first of all, he has to take a prior approval of CIT. Once that is done, then he can start the proceeding. Now, when he will conclude that the poem is in India, then he has to take again approval from a group of 3 CIT. That group of 3 CIT will be made by the chief CIT of that area. So, first to start the proceeding, he has to take an approval from 1 CIT, and to complete the proceeding, he has to take an approval from 3 CIT. Check it, please. So let's go ahead with the next part, which is also a continuation of poem only. There is one section 115JH, and there is a notification which came in 2018 for those companies who are becoming resident in India because of poem for the very first time. So till last year you are not a resident in India, but in the current year you are becoming resident in India because of the poem. Then what is the effect on your books of accounts? What is the effect on your depreciation, on your loss, on your unabsorbed depreciation, on your TDS, on your tax rate? All these things we need to answer. Okay. So for example, till last year the company was a non-resident, and in the current year the company became a resident because of the poem. Then whether it will get depreciation or not, and if yes, what will be the WDV on which it is going to get the depreciation. So pay attention, please. First of all, we need to find out, is there tax in the foreign country? If there is a tax in the foreign country, then one more question we need to answer, whether depreciation was allowed to that company in that country. If it was allowed, then WDV as per the tax record will be the WDV in the current year. Okay. So whatever is the closing WDV as per the tax record, that will become the WDV in the current year. So second question which we need to answer, there is a tax in the foreign country, but that company was not allowed depreciation under that particular law. So because of some reason, that maybe there is some presumptive income provision which is applicable to that company. So because of that, the provisions of depreciations are not applicable to that company. So in that case also you have to compute the WDV as per the tax record. So you compute the WDV as per tax record, even though that company is not eligible for depreciation in the foreign country, still you have to compute depreciation as per the tax record. Okay. Second possibility is if the foreign company is not assessed to tax. So if the country in which the foreign company exists, in that country there is no taxation law. So in that case, you have to compute the WDV as per the books of accounts. Okay, that is the first thing which you have to keep it in your mind. Check it, please. Now let's talk about loss. What about loss and UAD? So again, the same two questions which arise. If the foreign company resides in a country in which there is a taxation law, then take losses and UAD as per the tax record. If there is no taxation law, then take losses and UAD as per the books of accounts. Okay. Now, for how many years the losses will be allowed? For UAD, there is no time limit. You can carry forward and set off the UAD for infinite number of years. But for losses, how many years you can carry forward? You can carry forward only for the balance number of years. If the loss is 3-year-old, then you can carry forward for another 5 years. If the loss is 5-year-old, then you can carry forward for another 3 years. So you can only carry forward for the balance number of years. You cannot carry forward for the entire another 8 years. Okay. And now, second thing, the loss which you are going to carry forward in India and the UAD which you are going to carry forward in India, it is to be set off against which income? It is to be set off only against the income which accrued outside India and which is received outside India. It means the loss which you are carrying forward in India and the loss which and the UAD which you are carrying forward, it cannot be set off and carry forward. It cannot be set off against the income which is accrued in India or income which is received in India. It can be set off only against the income which is accrued outside India or income which is received outside India. Be very careful. Okay. Now. Suppose the foreign jurisdiction has made some assessment over there and then revised the loss over there and they revise the UAD over there. Then are we also supposed to revise the loss or revise the UAD in India? The answer is yes, obviously. Suppose earlier as per the foreign jurisdiction, the loss was 1 lakh rupees. Now there is some assessment which is happening in the foreign country. So the loss became 80,000. So even in India, I have to change that particular loss over here. Okay. Now there is one big problem which can come over here, that is the financial year as per India and the financial year as per the foreign country. If it is not same, then what to do? Suppose a foreign company became resident in India in 22-23 and the country in which it resides, in that country they follow calendar year, that is from Jan to December. Then in that case, what will I do? In that case, the government says that be very careful. What is the year in which the foreign country became resident? It became resident in what? 22-23. That is 1st April 2022 to 31st March 2023. Then you have to see the last accounting year of that particular company in the foreign country. The last accounting year will be Jan 21 to December 21. Okay. Then you have to make one PNL for Jan 21 and December 21. Then you have to see the intervening period. The intervening period is what? The leftover period from April 22 to December 21. What is the leftover period? It is 3 months. April, Jan, Feb, March 2022. Then you have to see that intervening period. If that intervening period is less than 6 months, if it is less than 6 months, then you have to do what? You have to merge that intervening period with the last accounting year. It means you have to make a PNL from 1st Jan 2021 to 31st March 2022. But if that intervening period is more than 6 months, then for that intervening period, you have to make a separate PNL, and for the last accounting year, you have to make a separate PNL. Okay. So here the middle, the leftover period. So you have to just check it once. You are becoming resident in 22-23. Okay. Then what is the last accounting year? Jan 21 to December 21. The leftover period is what? It is Jan 22, Feb 22, March 22. So that period you have to check whether it is less than 6 months or more than 6 months. Less than 6 months, merge with the last accounting year. More than 6 months, keep it as a separate financial year. Okay. Next. What is the applicability of TDS? If this company which has become resident because of POEM, if somebody is making payment to that person, whether it should deduct TDS as a foreign company under section 195 or it should deduct TDS as a resident, because this company is now foreign company also and this company now resident also. So the government has said that you have to deduct TDS as per section 195 and you have to deal this company, you have to deem that company as a foreign company and not as a resident for the purpose of deduction of TDS. This foreign company has now become a resident of our country. So is Indian government going to give them relief relief under 90 and 91, that is unilateral relief and bilateral relief? The answer is yes. The Indian company will give them the relief under 90 and 91. Don't worry about it. Now, this foreign company in the subsequent year, 22-23, they became resident for the first time. In 23-24 also, are they going to get the benefit of laws, benefit of UAD, etc.? The answer is yes, they are going to get the benefit of all these things in the subsequent years also. It is not a 1 year benefit. The benefit will carry forward for the subsequent years also. Okay. Next. Now, this company is a foreign company. Yes, this company is a resident also, but this company is not a non-resident, because this company has now become a resident. So, this company is a foreign company who is a resident. It is not a foreign company who is non-resident. Therefore, all the provisions of foreign company shall apply to this company. All the provisions of resident shall also apply to this company. But wherever the provision says that this provision is specifically applicable to a non-resident, then this company will not be eligible for that particular provision. So, if a provision is specifically for non-resident, then the provision will not be applicable for that particular company. Last but not least, just because this company has become a resident, it does not mean that it is a domestic company. The tax rate unfortunately applicable to this company will be 40%, 40% and 40% only. There is no relaxation in the tax rate unfortunately over here. Next one is a small clarification with respect to non-resident seafarers. If there is a non-resident seafarer, means a person who is a crew member of a ship and he is a non-resident. So, if he has an NRE account in India, and in that NRE account, if he is receiving salary, then that salary is exempt in the hands of the non-resident. So, if a non-resident seafarer having an NRE account in India, receiving salary in that will be exempt under the income tax law, no tax on that particular income. Let's move on to the next part. Here, the residential status completes from every angle. Now, let's move on to the next part, that is interest, royalty and FTS taxability in detail. First of all, we'll try to identify when interest, royalty and FTS are deemed to accrue or rise in India. When is interest income deemed to accrue or rise in India? It is accrued in India. It is deemed to accrue or rise in India as per 915 if it is payable by government, or if it is payable by resident, then also it is deemed to accrue or rise in India. But if it is payable by government, if it is payable by resident for the purpose of business and profession outside India, or the for purpose of other source outside India, then it will not be subject to deemed to accrue or rise in India. For example, I am a resident and I am taking a loan from non-resident and I am using that loan in India, then that interest is deemed to accrue or rise in India. But if I am using that loan in Sri Lanka for the purpose of business, or in Sri Lanka for the purpose of other purpose, then it is not deemed to accrue or rise in India. Similarly, when interest is paid by one NR to another NR, and if the money is used for business purpose in India, then it is deemed to accrue or rise in India. But if it is used for other purpose in India, for the purpose of investment in shares, investment in debentures, investment in banks, then it is not subject to deemed to accrue or rise in India. For example, one NR is giving loan to another NR, and that another NR is paying me interest. Is that interest accrued in India? That depends upon the NR who has taken the loan is using money how. If he is using money in India for the purpose of business and profession, then that interest is deemed to accrue or rise in India. If he is using that money in India for other purpose, then it is not deemed to accrue or rise in India. Similarly, royalty also, till here everything is same. But here the royalty point changes, that if one NR gives services to another NR and that NR uses that services in India, either for business purpose and even for other purpose, which is not covered in interest, even for other purpose, both the cases are subject to what? Deemed to accrue or rise in India. Check it please. So this is the point of differentiation between this point and the previous point. You can check it please. Okay. Now, in case of royalty, FTS and interest, the government has said that there is no need to have. These incomes are by default deemed to accrue or rise in India if they fulfill whatever is written over here. Whatever is written over here, if they fulfill that, they are deemed to accrue or rise in India. They need not render services in India. They need not have any place of business in India. They need not have any business connection in India. So these incomes are deemed to accrue or arise in India without any place of business, without any business connection, without any kind of permanent establishment in India. Check it please. So now let's go ahead with the taxability of interest first and dividend, and then we'll talk about the taxability of what? Taxability of the royalty and FTS. Okay. Let's talk about, there are four kind of interest over here. The first interest, the lender is non-resident and foreign company. In the second interest also, the lender is non-resident and foreign company. In the third interest also, the lender is non-resident and foreign company. But when the fourth one comes, the lender changes. FIIs and QFIs, foreign institutional investors and qualified financial investors. These are the lenders. So here the lender changes. Okay, you can circle it now. Now the borrower is different at every place. Everywhere the borrower is different. Here the borrower is Indian concern and government. Here the borrower is infrastructure debt fund. Here the borrower is just Indian company. And here the borrower is Indian company or government. So the borrower changes everywhere. The TDS will be deducted in the first section under section 195, in the second, third and fourth under 194 LB, 194 LC and 194 LD. Now what is the rate of TDS and what is the rate of tax? In the first section the rate is 20%, the second section it is 5%, third section in some cases it is 5% and in some cases it is 4%, that I will let you know in a while, and fourth case it is 5%. Okay, what is the time limit? There is no time limit in the first two sections, but in the third section, there is a time limit that the money has to be borrowed after 30th June 2012 but before 1st July 2023. So the money has to be borrowed between these 11 years, after 30th June 2012 but before 1st July 2023. But in the fourth section there is a time limit, but that time limit is applicable to a different parameter. Here the money, in the third section the money has to be borrowed between that period, but in the fourth section the interest has to be payable after 31st May 2013 but before 1st July 2023. You have to be very careful about it. Okay, so here the interest has to be payable after 31st May 2023 but before 1st July 2023. Okay, now the rate of interest in the first two sections will be decided between the borrower and the lender, but in the third and the fourth section the rate of interest will be decided by the government. It should not exceed the approved rate as approved by the government of India. In the first section you will raise the money by what? You will raise the money in the form of loans in foreign currency, in foreign currency. In second section you will raise loan in by any currency, not foreign currency, any currency would fine. In third case, you will raise the money by loans or long-term bonds, foreign currency, and these two things have to be in foreign currency. Or you can also raise the money in rupee denominated bond, and that rupee denominated bond can be in any currency, foreign or normal currency, it doesn't matter. In the fourth case, the rupee, you have to raise money. The Indian company will raise the money by rupee denominated bond in any currency. There is no currency mentioned, and the government will raise the money by government security. Here the security, government security is also by any currency, no currency mentioned. Okay, now the dividend income will be taxable flat at 20% in case of non-resident and foreign company. So in case of non-resident and foreign company, investing in the domestic company shares and earning some dividend, investing in the Indian company shares and earning some dividend, then that dividend will be taxable at 20%, 20% and 20%. Now there are certain specific points that which I have to raise one by one over here. The first thing is when it is 4% in 194 LC. In this third section, when it is 4%. So it is 4% in certain cases when a non-resident borrow money, when a non-resident lend you money in foreign currency from a source outside India by way of a long-term bond or a rupee denominated bond between 2020 to 2023, and he is buying these bonds and he is buying this rupee denominated bond through a listed recognized stock exchange in any IFSC. So be very careful. So if a non-resident is buying these long-term bonds and rupee denominated bonds which are listed on a recognized stock exchange which is in IFSC and after 2020 but before July 2023, then the tax rate will be 4%, 4% and 4%. Okay, be very careful. Now, where here there is one more security apart from these two. Apart from these two, there is one more security which is very recently added. That is, if the FII or QFI raise money through what? Raise money through a municipal debt security which is raised between what? And the interest is payable after 1st April 2020 but before 1st July 2023. So here there are not two securities. There is one more security which is added over here. You can check it over here, and that is the municipal debt security. Municipal debt security. Next. In 194 LC, the government has given some exemption, and this is a very important point which ICI has been testing again and again. You all know that in 194 LC that one of the instrument is rupee denominated bond. But if the rupee denominated bonds are issued between 17 September 2018 to 31st March 2019, if it is issued between this period, then the interest is exempt. That interest is not subject to tax at all. So you have to check this date in the exam that whether it is issued between 17 September 2018 to 31st March 2019 or not. If it is issued between that period, then it is exempt, always exempt and always exempt. And last but not least, where interest is always exempt. Where non-resident is outside India and there is a unit in IFSC, and that unit is in IFSC is borrowing money from non-resident, and that unit in IFSC is giving the interest to the non-resident, then the interest will be exempt under section 1015. Who is the borrower? The unit in IFSC. Who is the lender? Non-resident. And the lender is giving money to the to the unit, and the unit is making the payment of interest. That is exempt under section 1015. Check it, please. Now, against this interest and dividend income, are we going to get any deductions? No PGBP deduction, no IFOS deduction, no UAD. Nothing will be allowed. Nothing will be allowed. No chapter 6A will be allowed. No chapter 6A. But only one chapter 6A deduction will be allowed. That is ATLA. This will be allowed. Apart from that, no PGBP deduction, no IFOS, no UAD. Whether losses can be set off? Yes, losses can be set off. If you have some other losses, you can set off against this income. That is allowed. So there is only one positive note over here, that losses will be allowed, and there is one more positive, that in chapter 6A, there is only one chapter 6A, that is ATLA will be allowed to you as a deduction. Apart from that, you are not going to get any deduction apart from ATLA. Now, is the assessee, is the non-resident or foreign company liable to file the return? They are not liable to file the return if the certain conditions are fulfilled. First, the only income is the above income. They only earn the interest and dividend income, and their TDS is deducted, and it is not at the rate less than 115A rate. Suppose the DTAA rates are lower, and if the TDS is deducted at a lower rate, then they have to file the return. But the DTAA rates are higher, and their TDS is deducted as per 115A rates, then they are not liable to what? File the income tax return. Be very careful. Suppose the DTAA rate is 15% and 115A rate is 5%, and if the TDS is deducted as per 115A and they earn only this income, no need to file the return. But if the DTAA rate is even lower, that is 3%, and 115A rate is 5%, and if the TDS is deducted as per DTAA rates of 3%, then they have to file the income tax return. Check it, please. Further, the above incomes will not be liable for MAT wherever the normal tax rate is more than 15%. So if the normal tax rate is more than 15%, they are not liable to MAT. And the normal tax rate is more than 15% only in one case, and that is this case. So in this case, MAT will be applicable. In rest of the case, MAT will also not be applicable to the foreign company who are lending money in India. Okay. Now let's talk about the next part, and that is royalty and FTS. So who is the service provider over here? A non-resident or a foreign company is a service provider over here. Who is the service receiver? A service receiver is a government or Indian concern. At what rate it will be taxable? It will be again taxable at the rate of 10% or DTAA, whichever is more beneficial to the assessee. If DTAA rates are more beneficial, then the lower rate will be applicable to them. Now, is there going to be any agreement? Yes, there has to be an agreement, and that agreement has to be approved by central government. Very, very important. There has to be an agreement, and that agreement has to be approved by central government. If there is no agreement, you cannot come in 115A. To come under 115A, there has to be an agreement. Without that, 115A is not possible. Now, again, the same questions will arise. Whether against the royalty and FTS income, we are going to get some deductions. No deduction of PGBP, no deduction of IFOS, no deduction of set off and carry forward of losses. But yes, chapter 6A will be allowed. Against interest, chapter 6A, only one chapter 6A was allowed, that is ATLA. No other chapter 6A is allowed. But against this income, every chapter 6A will be allowed. Okay. Further. That is, no ROI is required to be filed if they earn only this special income, and their TDS is also deducted at the rate mentioned in 115A. So if the TDS is deducted at 10% as per the rate mentioned in 115A, they are not liable to file the return under the income tax law. Be very careful. Next. If there is a foreign company or non-resident outside India, and in India there is a National Technical Research Organization, check it over here. And if the foreign company or non-resident is providing some services to National Technical Research Organization and they are paying some royalty to them, then that is exempt under section 10(6)(d). It is absolutely exempt under section 10(6)(d). Now, there is a lot of dispute regarding what comes in royalty and what does not comes in royalty. And for that purpose, the government of India has given 3 explanations below the definition of royalty under section 9. The first confusion was, suppose if I buy a license of computer software, if I buy rights of computer software from someone, whether that will be considered as a royalty or not. So the government has said very clearly, if you buy a computer software license, rights of that computer software from someone, that is a royalty. But if you buy that computer software, be very careful. There is a very thin line of difference between what I am trying to say. For case 1, If I buy the rights of a computer software, there is Microsoft outside India, and from Microsoft I am buying the rights of the computer software, then it is a royalty. It should not be added to the block of asset. It will not be added to the block of asset. It will not be treated like an asset. It will be treated like a revenue expenditure, and that revenue expenditure will also be subject to TDS under section 195. But there is another case where I am buying the computer software for resale or for end use. That means I want to use that for the purpose of my business. So if I'm buying, there are three ways in which you can take that software. One is I am taking the software. Again, I am explaining the first case. It is very confusing if you do not understand the things properly. If you buy a software, if you buy the rights of the software because you want to further make the software, further you want to develop software, then that is a royalty. But if you buy the software to resell it, then it is not a royalty, then it is an asset. If you buy the software to use it, then also it is not a royalty. This is what the Supreme Court has to say in this particular case. Okay, then there is explanation 5, which talks about which has been introduced for the purpose of certain banking industries and credit card industry. Let me give you an example. There is SBI over here. Just try to understand my hand position. There is SBI over here and there is a customer over here. SBI has issued a credit card to the customer. Now that credit card customer is taking and going to a shop and swiping it off. Now when you swipe off a credit card, that credit card is verified. Now to verify that credit card, SBI is using the servers of Bank of Germany, because SBI does not have its own server. So it's using the server of Bank of Germany. So now SBI is giving credit card to customer is taking that credit card to shop and swiping it off, and that swipe off is using the server of what? Of Bank of Germany. At the end of the year, the Bank of Germany will raise invoice on SBI because SBI is using that particular server. Whether the amount which is paid by SBI to that server, to that Bank of Germany, whether that will amount to royalty or not, the department has said that yes, that amounts to royalty, whether or not the servers are directly used by SBI, whether or not the location of the server is in India, whether or not the possession of the server is in India, this is royalty and you will be subject to what? TDS under section 195. Next. Explanation 6 is for television program. Suppose there is a television program over here, say for example Z News. If it wants to telecast its program in the news channel on the TV, so it is using the satellite of a foreign company. So it is making some payment to the foreign company for transmission of program. Whether that will also be amounting to royalty? The answer is yes, that is also royalty and TDS will be deducted under section 195. Check it please. Next. Now there are two sections which will be fighting with each other in the exam, and you have to be very careful with them. Royalty and FTS is coming again and again at different place. One time we have just seen under section 115A. Now there is one more section for royalty and FTS which is given under 44DA. Now when to follow 115A, when to follow 44DA? Let's see. If the foreign company or non-resident does not having PV, they do not have a PE, then you will follow 115A. But if the non-resident and foreign company have a PE in India, it means they have a branch in India. For example, if Microsoft is providing services directly from US, it does not have a PE, then you will follow 115A. But if Microsoft is opening a branch in Bangalore and then providing the services of royalty and FTS, then you will follow 44DA. This is the basic difference between the two. Now let's see the treatment difference between the two. Here you do not get any deduction of expenses as we have seen earlier in 115A. Right hand side is 115A, left hand side is 44DA. In 115A you do not get any deduction of any expenses, any PGBP, any IFOs, nothing is allowed. But on left hand side you will compute income under the head PGBP after allowing all expenses. But you have to keep in mind certain points which I am saying now. First point, that is the branch which is there in India will get deduction of only those expenses which are wholly and exclusively incurred for the Indian branch. If the expenses are not wholly and exclusively incurred for the Indian branch, then you are not going to get the deduction. It means if there are some common expenses for Indian branch and foreign branch, you are not going to get the deduction of that common expense. Be very careful. Okay, this is the first thing that you have to keep it in your mind. The second thing which you have to keep it in your mind is, pay attention please. There is a branch in India and there is an head office in Singapore, and if the Singapore head office is giving some services, and if I'm making the payment to the branch, if I'm making the payment to Singapore head office, then that deduction will not be allowed. Why? Because that will be considered as a payment to self. If head office is giving services and I'm making the payment to the head office, then the deduction will not be allowed to me. The third case, if some third party is giving me services and my head office is making the payment and I'm reimbursing that amount to the head office, then it will be allowed as deduction. There is a very thin line of difference. If head office is giving me services, I am making the payment to head office, then deduction will not allow. If third party is giving me services, my head office making the payment and I am reimbursing the payment, then the deduction will be allowed. Check it please. Next, whether the deduction of chapter 6A will be allowed. Yes, in 115A is also it is allowed. Here also it is allowed. Losses, whether the losses of other business will be allowed. Yes, yes. Is there any maintenance of books of accounts? Here there is no need to maintain any books of accounts. Here there is a need to maintain books of accounts. Is there any requirement to do audit? Here there is no need to do any audit because there is no books, only what you will audit. Here you have to conduct audit and tax audit report has to be filed. What is the tax rate? Here it is 10% subject to surcharge and cess. Here it is 40% for foreign company and for other non-resident it is normal tax rate. Check it once. Okay. Now let's go ahead. The next provision is only for the foreign banking having an Indian branches. If a foreign bank is having Indian branch, then this provision is applicable. Otherwise, this provision is not applicable. So there is one explanation which has been put by the government over here. So let's take an example. This example will help you to understand exactly what this provision has to say. Suppose there is a foreign bank, say Bank of America, which is having headquarters in USA and one branch in India. And this is Bank of America Indian branch. Now, this bank is giving its loan to what? To its Indian branch. This branch of Singapore is also giving loan to Indian branch and in return they are paying interest. So the first question is, this branch is a separate P in India. Okay, so it will be assessed as a separate assessee in India. So the first question is the interest which it is paying, whether that interest will be subject to what? TDS or not. Whether that interest will be allowed as a deduction or not. First question. So the government said that yes, the interest will be allowed as deduction. Okay, so this interest will be allowed as deduction to the Indian branch. The second question is whether that interest will be chargeable to tax in the hands of the foreign bank or not. So the government said that yes, this explanation talks about that only, that this interest will be income in the hands of the foreign bank, and therefore if it is income in the hands of the foreign bank, this Indian branch has to deduct TDS while making the credit or while making the payment, whichever is earlier. So if they do not deduct the TDS on that particular interest, they will be considered as assessee in default. This is the only thing which is given over here. So if there is any foreign company having a foreign branch over here in India, a foreign bank having a branch in India like HSBC Bank, like Citibank, like Standard Chartered Bank, whatever interest they are paying to their head office or to any of the other branches, that interest income will be chargeable to tax in the hands of the other company, and if that is chargeable to tax in the hands of the other company, it will be liable for TDS in India. Okay, be very careful. Now next. Now there are three more sections over here. One by one we'll try to address all of them. We'll try to address one by one all of them, not all three of them together. The first section is 115AB, which is for overseas financial organization. Sir, what is an overseas financial organization? It's a non-resident only who have been given an approval by SEBI to invest in India, who has been taken an approval from SBI, SEBI and other authorities in India to invest in India. Sir, where are they investing? Now be very careful. Now they are investing in the UTI and mutual fund purchased in foreign currency. So now they are purchasing units of UTI, now they are purchasing units of mutual fund and in foreign currency. So in that case, their tax rate will be 10%. LTCG generally it is 20%, but for these people the LTCG is only 10%, 10% and 10%. Are they going to get any deductions? They are not going to get any deductions of PGBP. Obviously their PGBP income is not there only. They are earning LTCG income. So the question of PGBP does not arise only. No PGBP. The first proviso to 48 will not be applicable. That is, you don't have to do TTBR, TTSR, etc., which you do generally in first proviso to 48. The second proviso to 48 is also not applicable. It means indexation benefit will not be given to you. Okay. Then is the loss allowed to be set off? Yes. If you have some other losses, you can set off against this income. Are they liable to file the return of income? Yes, they are not getting any exemption from filing of ROI. If they are not getting any exemption from filing of ROI, then they have to file the return of income. Over here, it is mandatory for them to file the return of income. Okay. Now let's talk about the second section. In second section, who is the lender or who is the service provider? It is non-resident or foreign company. What are they buying? They are buying bonds of Indian company, or they are buying bonds of public sector company, or they are buying GDR, global depository receipts, and all of them are bought in foreign currency. So all of them are bought in what? Foreign currency. They are not buying in Indian currency. Be very careful. Now in that case, if the non-resident is buying these things, that is bonds of Indian company, bonds of public sector company, or GDR, on all of them are in foreign currency, then LTCG will be taxable at 10% and interest and dividend will be taxable at 10%. Okay. So LTCG also 10% and interest and dividend also 10%. The rest everything is same except the last point. In the last point, they are given exemption from filing ROI. If they only earn interest income and their TDS is deducted, they are exempted from filing ROI. If they only earn interest income and their TDS is deducted, they are exempted from filing ROI. Don't worry about it. Now we will talk about what the taxability of GDR in detail, which has been given after 1 or 2 pages. Now you come to the next page, that is 58.14. You will get the taxability of GDR over here. Now what is a GDR? GDR is nothing but an instrument which is issued outside India to raise money. So if an Indian company wants to raise money from outside India, they have to issue GDR outside India. But one problem over here under the income tax law is, income tax law only consider GDR of a listed company. In income tax law, GDR means GDR of only listed company. GDR of unlisted company is not considered to be GDR only for the purpose of income tax law. Be very careful. So here I have written, we conclude that 115AC does not recognize GDR which are representing unlisted companies. Unlisted companies can issue GDR. I am not saying they cannot issue GDR, but income tax law does not recognize them as a GDR only. Income tax law only recognize GDR of a listed company. Now let's take an example. For example, there is one listed company in India, say for example Infosys. Now it wants to raise money from outside India, so it will go to UK for example, and it will raise money through GDR. So it is issuing GDRs in UK. So if it is issuing GDRs in UK, so there is a person in UK who has bought that GDR. So if a non-resident is buying that GDR, and if a non-resident, which GDR? GDR of a listed company, because income tax does not recognize GDR of unlisted company. So the non-resident has bought that GDR. Now tax implication number 1, listen please. Now if that non-resident transfer that GDR to another non-resident outside India, so if a GDR of a listed company is GDR of a listed company, point number 1, is transferred by non-resident to another non-resident outside India, then that transfer is an exempt transfer under section 47(7)(a). So one NR can transfer the GDR to another NR, it will be exempt, exempt and exempt. Second tax implication. Suppose that NR who has bought the GDR, he does not want to transfer that GDR. He has bought the GDR, say he has bought 100 GDRs at the rate of 1000 each. So total cost will be 1 lakh rupees. And he has bought on 15th of April 2022. Now suppose he wants to convert that GDR into shares of Indian company, because he wants to trade in Bombay Stock Exchange. He wants to trade in National Stock Exchange. So GDRs are not traded in Indian stock market. In Indian stock market, what is traded is only shares, shares and shares. So suppose if he wants to trade the shares in Indian market, so he has to give the GDR back and he has to take the shares of listed company, that is Infosys. So he is making a request to the Indian company on 15th of September 2022. He is making a request that please convert my GDR into shares. So the company now is converting that GDR into shares on 15th of November. See the chronology of the event. On 15th of April, you are buying GDR. On 15th of September, you are requesting for conversion. And on 15th of November, your request is fulfilled. That is, you are given the shares. Now, this is amounting to what? Transfer of capital asset. You are giving GDR. You are taking shares. So, how the capital gains will be computed? The capital gains will be computed as sale consideration minus cost. What is cost? Cost is nothing but 1 lakh rupees is your cost of GDR. What is the sale consideration you are going to write? So the government says that here you have to write the fair market value of the GDR on the date on which the request of redemption was made. Therefore, you have to take the fair market value of the shares on 15th of September, because that is the date on which the request for redemption was made. And in our example, the fair market value on that date is 2,200 rupees. So 2,200 into 50 shares will give you the fair market value, and that will become the sale consideration. Now, let's go one step ahead also. Now, what does the shareholder has? The shareholder now has GDR or shares? It has shares. How many shares? It has 50 shares. Now, when he will sell these shares, how the capital gains will be computed? What will be the cost of acquisition? So whenever he will sell the shares, at that time again the government says that the cost of acquisition will be the FMV of the shares on the date on which the request for redemption was made. So everything revolves around the date on which you make the request for redemption. So FMV on the date on which the request for redemption was made, that will become the cost. So the cost of one share will be 2,200. The period of holding will also be counted from the date on which the request for redemption was made. So the period of holding will also be counted from 15 September 2022. So this is what this concept of GDR is all about. Let's move on to the third point, and that is what? that is 115AD, which covers two areas. One is foreign institutional investors and second is certain specified funds which are mentioned in 104D that we'll see in the revision of capital gains later on. Don't worry about it. Right now I'm not talking about what is a specified fund because that is a very big discussion. There are two types of specified fund that I'll be dealing in the chapter of capital gains. Don't worry about it later on. Now let us talk about what they are buying. What is the FII buying? What is the specified fund buying? They are buying securities other than 115AB purchased in any currency. Here there is no foreign currency mentioned. Here and here there is foreign currency, but here it is any currency. Now there are multiple rates over here. LTCG, the normal LTCG at 10%, the normal STCG at 30%, 111A will be at 15% only, 112A will be at 10%, and you will also get 1 lakh exemption that everybody gets. And for interest and dividend we are doing some kind of what? Discrimination. For FII the interest and dividend will be taxed at 20%. For specified fund there is lower rate, that is it will be taxed at 10% only. So FII interest dividend 20%, but for specified fund it is only 10%. And interest if it is mentioned in 194 LD, because FIIs are also covered in 194 LD. If you remember the four interest chart, interest or FIIs are also covered over here. So if the interest is that interest, then it will be subject to 5% tax. Then everything else is same as the first section 115AB. You can check over here. Now there is one more point which you have to keep in mind over here. The whatever concessional rate you are getting over here now, that will be available only to the extent the units are held by the non-resident. Suppose in this FII and in this specified fund, the total unit holders are suppose 100, and out of that the non-residents are only 60%, that is only 60, then only 60% of the income will be subject to this concessional rate. Balance 40% of the income will not be subject to this concessional rate. This is what it is written over here, and this is what it is written over here in the form of a formula. You can check this formula. This entire formula tells only one thing, that only that much income will be subject to concessional rate to the extent the units are attributable to the non-resident. So what you are supposed to do? You are supposed to find out the holding of non-resident as compared to the total holding. Suppose if the holding of non-resident is 60% as compared to the total holding, only 60% of the income will be subject to concessional rate. The balance 40% income will be subject to what? At normal rate. And further, you also have to file a concessional, you also file an annual statement under digital signature on or before the due date of filing of return, which is duly verified, which has to specify that how much is non-resident shareholding, how much is resident shareholding, how much will be subject to concession tax rate, how much will be subject to normal tax rate. That exercise has to be done by the assessee. Okay, so this is what this section is all about. What is specified fund? Don't worry, we'll be talking about the definition of specified fund in great detail when we'll be doing the revision of what? The capital gains. At that time we are going to address the specified fund definition. Now let's move on to the next point. That is a special chapter, very special chapter, which are given to only NRIs and not to everyone. Who are NRIs? Non-resident Indians are the NRIs. Let's talk about this special chapter which is covered under section 115C to 115I. Let's first of all see certain definitions. Who is an NRI? NRI is an individual who is either citizen of India or a person of Indian origin, but as per the residential status, that person is a non-resident. So a non-resident who is a citizen of India or a non-resident who is a person of Indian origin will be considered as NRI. The NRI has to buy certain specified assets. What are specified assets? There are 4 assets. One is shares of Indian company. Private company shares is also covered. Public company shares is covered. But the debentures and deposits are only of public company. Debentures of private company not covered over here. Deposits of private company not covered here. Only public company. Shares of both private and public companies covered. And government securities are also covered here. Now these assets have to be purchased in foreign currency, then only this section is applicable. And if these assets are purchased in foreign currency by NRI, then their long-term capital gains and their interest and dividend income will be taxed as per this particular chapter. And what is this chapter? This is an optional chapter. If you want to come, come. If you don't want to come, don't come. That is your choice. Are we going to get any deduction of PGBP? No deduction of PGBP, no deduction of IFOs, no chapter 60 available. Nothing is allowed against your other above income. Then is the first provision to 48 applicable? Yes, the first provision to 48 is applicable. It means if the foreign currency rates are given, then while computing the capital gains, you have to convert that into first foreign currency, then again reconvert that into what? Indian currency as per TTB or TTSR. Then is the second proviso available? No indexation benefit is available. The second proviso to 48 is covered under is talking about what? Indexation benefits under the income tax law. Other incomes will be taxable at normal rates only. The only incomes which are covered over here is LTCG and interest and dividend income. LTCG will be taxed at 10%, interest and dividend income will be taxed taxed at 20%. Other incomes will be taxable at normal rates. Now, one of the important benefit that you get over here is if there is a long-term capital gains from the above asset, and if you purchase again within 6 months the specified assets, that is shares of Indian company, public or private, debentures or deposits of public company or government security within 6 months, then your capital gains will be exempt. But here you have to invest the entire sale consideration the way you invest in 54F. The entire consideration have to be invested over here. If you do not invest the entire consideration, then proportionate capital gains will be exempt. That is LTCG into cost of new asset divided by net sale consideration. And the new asset which you are purchasing within 6 months, so that you get your old capital gains exempt, you want, na? So you are purchasing the new specified asset within 6 months. The new asset should not be sold for a period of 3 years. There is a lock-in of 3 years over here. If you sell within 3 years, then the capital gain exempted earlier will be withdrawn, and the capital gain on new asset will also be charged for you. So capital gains which were exempted earlier is exempted subject to a condition: you do not sell the new asset within a period of 3 years. Check it over here. Okay. Now, are they liable to file the return? They are not liable to file the return. These NRIs are exempted from filing of return if they earn only this income and their TDS is also deducted. If they earn only this income and TDS is also deducted, they are not liable to file the return. Next. Whether the chapter will apply if the non-resident become resident in the subsequent years. Yes, the chapter will apply in the subsequent year also if the non-resident become resident in the subsequent year. And last but not least, this chapter is optional. It is not mandatory to follow this chapter. If you want to follow. If you don't want to follow, don't follow. That is your choice. Okay. Now we will talk about certain exemptions given to certain non-residents and foreign company. So let's talk about section 1048, 1048A, 1048B first of all. 1048B talks about what? If there is a foreign company who is selling some crude oil or other notified goods and services, and the money is received in India, and it is also received in INR to any person in India. They are selling the crude oil to any person in India. Then further, they are not engaged in any other activity in India, and they have an agreement with central government, and there is a national interest of Indian government. Then the income earned by the foreign company will be exempt in India. I'll again say, if there is a foreign company who is selling some crude oil or other goods or services as the government may notify, to whom they are selling? To any person in India if they are selling. And if the money is received in India and it is also received in Indian currency, that is INR, and they should not be engaged in any other activity in India, and there has to be central government agreement with them, and there has to be national interest in that, then their income is exempt. Check it please. Now, how the second section is different from the first section? We need to just identify that only. Here also there is a foreign company, but here the foreign company is not only selling the crude oil, but it is storing in India and then selling. In the first section they were not storing, but here they are storing and then selling. Secondly, they are selling to any resident in India. In the first section they are selling to any person, but here they are selling only to resident. Thirdly, here the income has to be accrued in India. It may not be received in India, it may not be in INR. It is fine. So here it should be received in India, it should be received in INR. Here these conditions are not mentioned. Next, here it is mentioned that it should not be engaged in any other activity. Here it can be engaged in other activities also. There is no harm in that. It can be engaged in other activity, and the last point is same. There has to be an agreement with central government. That agreement is generally for 5 years, 6 years, not more than that. Okay. Now, suppose the agreement is for 5 years. And after 5 years the time period is expired, and now if there is some leftover stock, so if there is some leftover stock which I am selling after the agreement expires, so after the expiry of agreement, if I sell some leftover stock, then that is also exempt under section 1048B. Check it please. So if the agreement is for 5 years and after 5 years the agreement expires, so whatever is the leftover stock, whatever I will sell, that is also exempt under 1048B. Next. What if the agreement is of 5 years and if I terminate the agreement within 2 years, and after the termination of the agreement if I sell the stock, then also it is exempt? Yes, if you terminate the agreement in between and if you sell the stock after that, then also it is exempt under the income tax law. Check it please. Now let's go ahead with the next exemption. We will try to cover all the exemptions which are applicable to non-resident and foreign company over here. So here, suppose if there is a non-resident who is transferring some non-deliverable forward contract. Now there are two more instruments which are added by Finance Act 2022. So if there is a non-resident who is transferring some non-deliverable forward contracts or offshore derivative instrument or over-the-counter derivative, you might have heard about all those things in your SFM paper, okay, entered into with an offshore banking unit of an IFSC. So these contracts are entered with what? Or with an offshore banking unit of an IFSC. So if a non-resident is transferring these contracts which are entered into with an offshore banking unit of an IFSC and which commences operations on or before 2024, then the transfer, whatever capital gains will arise out of transfer, that will be exempt under the income tax law. Next. Suppose there is a non-resident which is outside India and who is giving to us on lease an aircraft or ship. He is giving aircraft or ship to lease. To whom? To a unit which is located in IFSC. So the person who is receiving on lease is an IFSC person. The giver is what? Is a non-resident or foreign company. Then whatever interest or royalty we will pay to that person, that will also be exempt under the income tax law. Check it please. Okay. Next. Suppose there is a non-resident over here who is having some portfolio of securities and which is managed by what? A portfolio manager which is located in IFSC. So if the portfolio manager of that particular non-resident is in India in IFSC and the non-resident is outside India and that portfolio manager is buying and selling the shares on behalf of that non-resident, then that income of that non-resident will be exempt in India, provided that income should be accrued or deemed to accrue outside India. It should not deem to accrue or rise in India. That income should be accrued outside India. If that income is accrued in India, then it will be taxable. For example, if the non-resident is outside India and if that particular portfolio manager is in India in IFSC, and if that non-resident is buying the shares of what? From BSC of Reliance Industry, then it is accrued in India, then it will be taxable. Then you will not get the relaxation. The relaxation is available only if the non-resident is trading in say Nasdaq or Dow Jones or in foreign stock exchanges, not in the Indian stock exchange. If it is doing in the Indian stock exchange, then it is taxable. Okay. Next one we are keeping on hold, that you can do it with capital gains later on, because that covers concept of resultant fund, etc., which will be coming in the chapter of capital gains. Next one, which is given as a relaxation to certain individuals who are working in an embassy. Suppose there is in India, there is a US embassy, and in that US embassy, there are some foreign citizens who are not citizens of India. There are some US citizens who are working over there, and the US government is paying them remuneration. Then that remuneration is exempt in India, subject to some condition. First condition, the remuneration which Indian government pays to our corresponding officials in United States, that should also be exempt. Then we will exempt your remuneration. Otherwise, we will tax your remuneration also. For example, in India, there is a US embassy. In US, there is an Indian embassy. In US embassy, there is a citizen of US, and in Indian embassy in US, there is a citizen of India. So US government is making the payment of remuneration to India, to that person who is sitting in US embassy in India. So that remuneration will be exempt. If US will also exempt what? The remuneration in the hands of the Indian citizen in the US, then only we are going to exempt. Otherwise, we are not going to make it exempt. Second condition, that officer should be representing that country in India. And the third condition is that officer who is working in India should not be engaged in any other business or profession or employment in India. Check it please. That officer should not be engaged in any other business or profession or employment in India. Check it please. Now next and the last exemption, there is some foreign national who is working in a foreign company. Suppose there is some employee of Apple who is working in some Apple company. Okay, now Apple is sending that employee to India for some days. Okay, and Apple is paying salary for that particular days for which he is staying in India. Then that salary will be exempt provided some conditions are fulfilled. So Apple employee is coming to India for some days, then his salary will be exempt for whatever days he is in India. That's subject to some condition. Apple should not be engaged in any business or trade in India. Apple should not have any business or trade in India. Second, Apple that employee stay in India should not exceed how much? 90 days. Maximum that employee can stay in India is for how many days? 90 days. He should not stay for more than 90 days. And third, Apple should not be liable to deduct that particular remuneration as a deduction as an expense under the income tax law. Apple should not claim that expenditure as an expense under the income tax law. If these three conditions are fulfilled, the remuneration received by the foreign national from the foreign enterprise will be exempt under the income tax law. You can check it over here. Next one is a very important section for your exam. That is talking about sportsmen, sports association and entertainers. If these people are coming to India and earning money out of India, then that will be subject to what? Tax. It is not exempt. It is subject to tax at a particular rate. Now, the ideal time is to discuss this particular provision because IPL is going on these days. So, if there is a non-resident who is not a citizen of India, he should not be a citizen of India, and he participate in any game or sport other than the game referred in 115BB. What are the game referred in 115BB? Those are all casual games like your crossword, like your Ludo, etc. All those games are covered over here. Those are casual income. Those are subject to 30% income. So if a non-resident who is not a citizen of India, who is coming to India to participate in any game or sport, then 20% flat tax will be applicable. If he is doing some advertisement and he is earning money out of advertisement, then also 20% tax. If he is contributing certain articles to any game or sport in any magazines, any journal, any newspaper, then that will also be subject to 20% tax. Be very careful. So in these three cases, the non-residents income will be subject to 20% tax. Apart from that, if there is a non-resident sports association who is coming to India for an event in India and they are getting some guaranteed money from the Indian concerns, then that will also be subject to 20%. Let me give you an example. For example, there is a non-resident association by the name called as International Cricket Council England, that is ICC, and they are coming to India for World Cup in 2023. As you all know that World Cup cricket is there in India in 2023. Now, if the BCCI, that is the Indian Cricket Board, is making some payment to ICC, then that payment will also be subject to tax in India. That is also mentioned in the Supreme Court judgment of BCCI versus in Sri Lanka, Board of Control for Cricket in Sri Lanka, and Pilcom versus CIT. This is also mentioned in this particular case. This case law was in respect of 1996 World Cup, which was co-hosted by India, Pakistan and Sri Lanka, and the BCCI made payment to BCCI made payment to Australian Cricket Board also, the Sri Lankan Cricket Board also, West Indian Cricket Board also, England Cricket Board also, South African Cricket Board also, New Zealand Cricket Board also. All those payments will be subject to TDS in India, because ultimately every country has come to India to participate in India, and that World Cup was co-hosted by India. Therefore, it was subject to tax in India. Next, if there is a non-resident entertainer who is not a citizen of India, non-resident entertainer who is not a citizen of India, and they are performing in India like singing, dancing, music, etc., they will also be subject to 20% tax in India. Are they going to get any deduction out of the above income? No deduction or allowance out of the above income will be allowed to the assessee. We are really sorry for that. Are these non-resident sportsmen or sports association, etc., or entertainer liable to file the return? They are not liable to file the return if they earn only the above income and that TDS is deducted. If only above income is earned and TDS is deducted, then there is no liability to what? File the return of income. Then where the TDS is deducted of these people? These people's TDS is deducted under 194E. Are umpires and referees also covered in this section? No. Umpires and referees are not covered in this section. Umpires and referees are not sportsmen. They are professionals, no doubt about it, but they are not sportsmen. They will not be covered under this section. So if the umpire is a resident, then it will be covered under 194J, and if the umpire is a non-resident, it will be covered under 195. The above incomes are flat taxable at 20%, and the TDS of this section is covered under 194E on credit or payment, whichever is earlier. There is no threshold over here. The TDS rate is also 20%, and in 194E, umpires and referees are not covered, as I have told you earlier. Check it once. Now let's go ahead with the next one. Next one is what? If a foreign company, next one is also for a banking company also only, and it is not for other people. So if there is a foreign bank, say Bank of Germany, having a branch in India, so Indian government is saying that why don't you convert that branch into an Indian subsidiary? So the bank has certain questions. If I convert the Indian branch into an Indian subsidiary, whatever assets I will transfer, will you charge capital gains? Whatever losses I will transfer, will you allow? Whatever UAD I will transfer, will you allow? Whatever MAD credit I will transfer, will you allow? So the government gave positive answer under section 115JG that if a foreign bank has a branch in India, and if they wish to convert that into an Indian subsidiary as per the RBI guideline, then whatever assets they will transfer exempt, whatever apart from assets, whatever assets they will transfer, that will not be subject to capital gains. Whatever losses are there, you can transfer it to the new company. Whatever UAD you can transfer to the new company, and you can also transfer the MAD credit to the new company. All those things are allowed over here, but you have to convert this. You have to do this as per the scheme notified by government. That's it. That is the one important thing that you have to keep it in your mind. You have to do it as per the scheme notified by central government. You have to keep this thing in your mind. Okay. Now, later on, if you violate certain conditions which are mentioned in the scheme notified by central government, then the government will what? Withdraw your exemption, will recompute your income, and the assessing officer will get 4 extra years to recompute your total income. Check it, please. So let's go ahead with the next provision, and the next provision is a presumptive income provision, where we are going to do a lot of presumptive provisions. Some of the presumptive provisions we have already done in the chapter of PGBP, but that was mainly in respect of residents. So right now, today we are going to talk about presumptive incomes with respect to certain non-residents. Okay, so the first presumptive income is given in section 172 versus section 44B. What is section 172? 172 is a recovery section. Now this section is applicable, 172 as well as 44B is applicable to a shipping associates, not applicable to other associates. This is only applicable to associates engaged in what? In a shipping business. Okay, now let me give you an example. Suppose there is some non-resident ship which is coming to India, and now they are taking people from here, passengers, goods, livestock, mails, etc., and they are earning some money. That money will also include demurrage charge and handling charges. All those things will also be included. So the Indian government says that whenever a ship leaves India, the non-resident has to consider 7.5% of that revenue as its income. Okay, that revenue will also include handling charge and demurrage charge. So whenever the non-resident ship will leave India, 7.5% of the revenue will be considered as its deemed income. Okay, against that revenue, he will not get any deduction, because this revenue is computed, this deemed income is computed as per section 172. And as per section 172 overrides the entire income tax law, and because it overrides the entire income tax law, the non-resident is not going to get any deduction today. So the revenue is 1 crore, 7.5%, 7.5 lakhs. Now on that, the non-resident has to pay 40% tax today itself. Otherwise, the captain of the ship will not be allowed to leave the ship. Okay, or else they have to appoint one agent in India on the behalf of the non-resident, who will pay the tax within 1 month. So either they should pay the tax immediately when they are leaving, or within 1 month through an agent. They should appoint an official agent in India. Okay, now in that case, they have to pay 40% tax, which is applicable to a foreign company. So even though the non-resident is an individual, still the non-resident is liable to pay 40% tax. Now this section is an overriding section. This section overrides the entire income tax law. Okay, now the assessee will raise some questions. Assessee will say that, why the hell you are not giving me deductions? Why the hell you are taking 40% tax from me? So now there is a proper provision for you. Don't worry. Next year you have an option. You have an option under 44B, that under 44B you can show the income as 7.5%. Income will be shown as 7.5%. No PGBP deductions will be allowed. But now in 44B, you will be allowed with set off of loss. You will be allowed with chapter 6A. These two deductions will be allowed to you, which was not allowed in 172. Plus here you are going to get what? Here you are going to get a deduction. Here you are going to be taxed at a rate of your normal slab rates. Whatever is your normal slab rate, that is the slab rate which is going to be applicable in your case over here. So what was happening in 172 in the last year? In 172 in the financial year, what was happening? Whatever income you are earning from leaving the ship from India, that income was subject to directly 7.5% income, 40% tax without any deduction. Now what are the benefits of coming in 44B? You can file the return, come to 44B, show the income as 7.5%. No PGBP deductions will be allowed even in 44B, but you will get chapter 6A deduction, you will get losses deduction, and you will also get the benefit of slab rates over here, because of which what will happen? You will get some advance tax. The tax which you are paid in 172 in the last year now will be treated as advance tax by the government, and in the next year, obviously the liability in the next year will be lower as compared to the liability in the previous year. Therefore, suppose the liability in the previous year under 172 was 2 lakh and liability over here is 1 lakh. So the government will give you refund of 1 lakh as per the Supreme Court judgment of A.S. Glitter, and that refund will be given along with the interest. So be very careful. In 172 you pay tax. In 44B you have to again show that income. Calculate the income, take some benefits which was not allowed in 172, take the benefit of tax rate which was not allowed in 172, and take the refund along with interest. Okay, now along with that, 44B also covers one more income which is not covered in 172. Suppose the ship is leaving from Singapore to Dubai, or Dubai to Singapore. It means the ship is not leaving from India. The ship is not leaving from India. Ship is leaving from Singapore to Dubai, or Dubai to Singapore, and the money is received in India. Now that income cannot be covered in 172, because 172 only covers that income where the ship is leaving from India. So in that case, where the ship is leaving from two other countries, not India, then in that case, that income will be directly taxed under what? That income will be directly taxed under 44B. So 44B covers two income. One which is covered in 172 also, and second which is not covered in 172. Okay, so there are two incomes which are covered in 44B over here. Now I have kept some differences between the two. Now 44B is a charging section, 172 is a recovery mechanism. 172 only covers one income, which income? Where the goods are leaving India, where the ship is leaving India. But 44B covers two income. This income is also covered, and one more income, Singapore, Dubai, Dubai, Singapore, which I have told you. Here the tax rate is normal, here the tax rate is flat 40%. Here also you are not going to get any deductions under PGBP. PGBP deductions are not allowed in both the sections. But here you are going to get in 44B, brought forward losses, chapter 6A, you are not going to get any deductions in 172. Oh, I hope it is clear to all of you. Coming to the next section, which talks about non-resident aircraft business. If a non-resident is engaged in aircraft business, they will be deemed to be having an income of 5% of the income. When it will be chargeable, when it will be considered as 5% of the income, this is income, this is not tax rate. Tax rate will be the normal rate which is applicable to everyone. The way it is applicable to others, the same tax rate will be applicable to non-residents also. So this is not a tax rate, this is a normal income. That is, this is deemed income. So the non-resident aircraft business will be subject to 5% deemed income. When it is deemed income considered? When the aircraft is leaving India. So when the aircraft is leaving India, it will be subject to 5% income. But when the aircraft is leaving from outside India, but the money is received in India, when the aircraft is leaving outside India, when the aircraft is leaving from New York to say Mumbai, then in that case the money has to be received in India, then also it will be subject to deemed income in India. Okay, the third one, 44BBB, very important section. The importance in this section is only available to a foreign company, not available to every kind of non-residents. So the previous two section was available to foreign companies also, other non-residents also, but this section is only available to a foreign company, not to other non-residents. Which foreign companies are covered? A foreign company who is engaged in construction or erection of plant and machinery or testing or commissioning thereof as a turnkey project. Turnkey project means a project which is complete in every sense. So if a foreign company is engaged in certain construction activity, erection of plant and machinery, testing, commissioning, turnkey project, then they are liable for deemed income of 10%. Now here the government is giving some extra benefit which was not available in the previous two section. If the assessee tells that the income of the assessee is lower than 10%, then they can maintain books of accounts and conduct tax audit and show lower profits also in the previous two sections, that is this and this. You are not allowed to show the lower profits. Lower profits are not allowed to be shown in the previous two sections, but in this section the government is allowing you to show the lower profits also. Next, again coming back to 44BB, that is covering only non-residents now. All non-residents are covered. This is the only section 44BBB where only foreign companies covered. Here also all non-residents are covered. Now what is this non-resident doing? This non-resident is providing some services, some facilities, or it is also providing plant and machinery on rent. For what purpose? It is providing either services, or it is giving plant and machinery on rent for prospecting, extraction or production of mineral oil in India. It will be subject to 10% deemed income. Okay, now here also if you want to show lower profits, you can show, you can conduct tax audit, you can maintain books of accounts, and you can show lower profits lower than 10% also. Now there is one doubt which was coming to assessee's mind: the services and the facilities which are covered here. What if that service is a technical service mentioned under 115A or 44DA? Then whether we should follow 115A, 44DA, or whether we should follow this section. So the law has clarified that if this service is a technical service as mentioned in 115A and 44DA, then you should follow that section. You should not come over here. It means you will come over here only if it is a general service or general facility. If it is a technical service or technical facility, then you are not going to come here. Go to the special section of 115A or 44DA as the case may be. And when 115A is applicable when there is no PE, and when 44DA is applicable, 44DA is applicable when the non-resident has a PE in India. Next. Can the AO tell that your income you are showing 10%? No, it is actually 12%, 13%. That is not allowed. That is not allowed in these sections. But yes, in these sections the AO can assess your income at a higher rate also. But in these sections the AO has to accept 7.5%, 5%, 10%, 10%. Whatever is the deemed income, that AO has to accept. But in these sections which we have done in PGBP, the AO can also inflate your income if he feels that your actual income is low and is more than your deemed income. Last but not least, if there is a foreign company and who earns only these four incomes which are mentioned in 44B, BB, BBB and BBA, if a foreign company is earning only these incomes, then they are not liable for MAT under the provisions of 115JB. The provisions of MAT will not be applicable for those particular companies. Okay. Now let's come to the next one, 44C. That is, if a non-resident having a head office outside India and having a branch in India, then whether the head office will, whether the branch in India will get the deduction of head office expenses or not. The head office outside India, the branch is in India, the head office expenditures will be allowed in India or not. It will be allowed subject to 5% of the adjusted total income or actual amount attributed to the branch, whichever is lower. So 5% of the adjusted total income or actual amount attributed to the Indian branch, whichever is lower. Obviously, you will ask now, what is adjusted total income? Adjusted total income means nothing but total income plus these items. What are these items? Take total income and then add unabsorbed depreciation, add brought forward losses, add capital expenditure of family planning, not revenue expenditure, add chapter 6A and then add the actual expenditure debited to the P&L. If you do these things, you will get the adjusted total income. Take 5% of that, compare with actual, whichever is lower will be considered to be what? As your deduction of what? Head office expenditure to the branches in India. Next, let's do a detailed analysis of a what? Of a business connection definition and income deemed to accrue or arise in India. Here we are going to do analysis of section 911, 912, 913, 914 and 915, 6, 7 we have already done. In what? In the discussion of interest, royalty and FTS. So here we are going to do discussion of 911, 12, 13 and 14. These 4 clauses we are going to discuss one by one. The first clause talks about business connection. What do I mean by business connection? Business connection means any business activity which is carried out by a person through a person on behalf of a non-resident. So suppose the non-resident is outside India and there is a person in India, and on behalf of that non-resident, that person in India is doing some activity. That activity will be called as business connection. And if business connection is established in India, non-resident's business income will be taxable in India. Okay. Now, there are some issues over here which we have to understand one by one. Suppose issue 1. If there is a non-resident who is outside India and if he is making one agent sit in India on behalf of the non-resident and he is giving that agent an authority to habitually means regularly do contracts on behalf of non-resident in India, then it is deemed that that non-resident has a business connection in India. Secondly, if that agent does not have any authority to conclude contract, but he regularly deliver goods on behalf of the non-resident in India, it means that agent is only maintaining one warehouse in India through which he is delivering goods to the customers of the non-resident in India. Then also it is a business connection. Third case, he does not have any authority, neither he delivers any goods. He only secures orders in India mainly and wholly for that non-resident. Who is that non-resident? That non-resident is Mr. X. So if an agent in India is mainly and wholly securing orders for a non-resident who is outside India, then it is deemed that that non-resident has a business connection in India. Now in that there are a lot of twists also. Who is that non-resident? That non-resident is Mr. X. Now for Mr. X, I am mainly and wholly doing the activity. But for Mr. Y, I am doing little bit activity and Mr. Y controls Mr. X or Mr. X controls Mr. Y or X or Y is controlled by some other person Z. Then also Y's income will also be deemed to accrue or arise in India. Be very careful. I am not mainly or wholly doing activities for Y, but Y is controlled by X or X is controlled by Y or both are controlled by third person Z, then Mr. Y's income will also be deemed to accrue or arise in India. This is what it is mentioned over here. One important thing to make this income deemed to accrue or arise in India, that is in all these 3 cases, the agents which are there in India have to be a dependent agent. They have to be dependent on the non-resident. If they are independent agent and they are doing their business in an ordinary course of business, then their income will not be deemed to accrue or arise in India. If they are dependent agent, then only if they are doing any authority, they have any authority to conclude contract, they have any authority, they don't have any authority but they deliver goods, they don't have any authority but they secure order, they should be dependent on the non-resident. They should not be any independent agent. Independent agents are not covered over here. Next. Significant economic presence concept is brought by Finance Act 2020, then extended. Now it is applicable from 1/4/2022. Now this concept is applicable to companies like Facebook. That is companies like Facebook who does not have any business connection in India but they have a significant presence in India. What do I mean by significant presence? The government has defined the significant presence as if the aggregate payment during the financial year exceeds 2 crore rupees, or if that non-resident has 3 lakh users at least in India. If the aggregate payment to that non-resident exceeds 2 crore rupees, or if that non-resident has 3 lakh users in India, in either of the case, it will be said that companies like digital companies like Facebook, Google, Twitter, etc. are deemed to have what? A significant economic presence in India. And in that case, their income will be deemed to accrue or rise in India, irrespective of whether the agreement was entered in India or not, irrespective of whether they have residence or place of business in India or not, irrespective of whether the non-resident renders services in India or not. So if a digital company like Facebook or Google are having 3 lakh users in India, or if they are getting paid from India of more than 2 crore rupees in the entire financial year, they are deemed to have a significant economic presence, and that is a business connection under the income tax law. Now there are certain points which are not included in the definition of business connection. It means in these cases income will not be liable to be taxed in India. What are those cases? First of all, if all the operations of the non-residents are not carried out in India, only some of the operations of the non-residents are carried out in India, then the income taxable in India should also be reasonably attributable. For example, if there is a company who is doing some activity in India and some activity outside India, then their entire income cannot be taxed in India. Only a reasonable income should be taxable in India. But there are 3 incomes which the government says that will always be taxable in India, will always be attributable to India, will be chargeable to tax in India. These are the 3 incomes from one by one. I am telling one of them, all of them one by one. Income from advertisement. If some company is earning some income from advertisement by targeting customers in India, for example, if Facebook is doing advertisement for what Samsung, and they are targeting Indian customers and they are earning income out of it, then that income will always be deemed to accrue rise in India. I have given example for all of them in the class to all of you if you remember. Second, if you collect data from a person resident in India and then you sell it, suppose if a company is collecting data from Indian residents and then selling it, then that income will always be deemed to accrue or arise in India. And third, with the help of that data which is collected and given to somebody, if there is a sale of goods which is happening with the help of that data, then that income will also be deemed to accrue or rise in India. These 3 incomes will always be deemed to accrue or rise in India. These 3 incomes will be attributable to the operations carried out in India. Next, if there is a non-resident who is coming to India only for purchase of goods, that too for export out of India. So if you are coming to India for purchase of goods for the purpose of export out of India, your income is not deemed to accrue or rise in India. Next, if there is a non-resident news agency who is coming to India to collect news and views only for the purpose of transmission out of India. So there is a say for example BBC is coming to India. Example, BBC is also transmitting news in India also. But let me give an example. Suppose if BBC is coming to India and they are collecting news from India and they are transmitting the news out of India, they are not transmitting in India, then it is not deemed to accrue or rise in India. Next, suppose if there is a non-resident film producer who is coming to India for shooting of a film, cinematographic film, then the income of that film producer will not be deemed to accrue or rise in India, subject to some condition. If that producer is an individual, he should not be a citizen of India. If that producer is a firm, none of the partners should be citizen of India or resident of India. All partners should be not citizen, non-resident. And if it is a company, then none of the shareholders should be resident in India. None of the shareholders should be what? Resident in India or citizen of India. Check it please. Let's move on to the next one. Suppose if there is a foreign company who is coming to special notified zone which is in Mumbai. For what purpose? They are only coming to display their uncut and unassorted diamond. So if a foreign company is coming to Mumbai in Bharat Diamond Boards, which I have told you, which is a special zone notified by central government only for display of uncut or unassorted diamonds, their income will not be deemed to accrue as in India. No business connection will be established. Here the concept of business connection is completed. Now let's move on to the other heads of income. We need to explain the deemed to accrue or rise in concept for every head of income. So this we have completed for PGBP. Earlier we have completed for interest, royalty and FTS also. Now let's talk about income from other sources and income from house property. When income from other sources and income from house property will be taxable in India? It will be taxable in India if your property, that is movable or immovable property, is located in India. If the property is located in India and if you are earning any income out of that, then it will be subject to tax in India. It will be deemed to accrue or arise in India. Next point is something which is related to transfer pricing. So we'll address that issue after transfer pricing is completed. Next one, when salary income is accrued in India. Salary is accrued in India when the salary is earned in India. When it can be said that the salary is earned in India. The salary can be said to be earned in India when the services are rendered in India. If the services are rendered in India, it would be treated that salary is earned in India. Further, if any salary is payable by a company to the employee for the rest period or leave period, which is a part of the contract, generally what happens if you are working in a company, the company also pays you for the rest period, leave period, that is a part of your contract, then that salary is also deemed to accrue or rise in India and it will be subject to tax in India. Next, if a salary is payable by government to a citizen of India for services which are rendered outside India. So, for example, Indian government is making payment to a person who is located in an Indian embassy in USA. So, Indian embassy USA, a person is working over there. So, Indian government is paying salary. Then that income is also deemed to accrue or rise in India. But the allowances and perquisite given to them is exempt under section 10(7). Be very careful. Next, let's talk about the dividend income. A dividend paid by an Indian company outside India is deemed to accrue or rise in India. That will be subject to tax in India. If an Indian company is making payment of dividend to any person outside India, that will be subject to tax in India. Next, let's talk about the fund manager's income and the eligible investment fund income, whether it is deemed to accrue or rise in India or not. Section 9A gives relaxation to the eligible investment fund. And it says that if the fund is located outside India and if the manager is in India, then the income of the fund will not be liable to tax in India if they fulfill 17 conditions. 13 conditions have to be fulfilled by the fund and 4 conditions have to be fulfilled by the manager. If 17 conditions are fulfilled, then the income of the eligible investment fund will not be liable to be taxed in India. Which are those 17 conditions? First condition, the fund has to be a non-resident in India. Second condition, the fund has to be of a country with which India has a DTAA. Third condition, the aggregate participation of the residents in the fund should not exceed 5%. It means the Indian investor should not be more than 5% in the fund. But if the Indian investor is a fund manager, it is allowed for the first 3 years to invest up to 25 crore rupees. So it means if a fund manager is investing in the fund up to 25 crore rupees, it is allowed even though it is crossing 5% criteria. 5% criteria is not applicable to a fund manager for the first 3 years of the fund. Okay. Next, the fund should be covered. The fund which is located outside India, which is a non-resident fund, it should be covered by investor regulation protections. Like in India, all the funds are covered by SEBI. So there has to be a similar SEBI institution in the foreign country. Next, the fund should have at least 25 members who are not connected to each other, who are absolutely not related to each other. At least 25 unconnected persons should be there in the fund. Next, any person along with a connected person should not hold more than 10% in the fund. So one person along with its connected person should not hold more than 10%. Next, 10 or less members taking together in combined 10 or less members should not hold more than 50%. It should be less than 50% stake. So 10 or less members should not hold 50% or more. It has to be less than 50% stake. Next, the investment in any entity should not exceed 20% of the corpus. The fund is investing in lot of companies, so it should not expose too much in one company. Therefore, it should not invest more than 20% in any company. Next, the investment fund should not invest in its associate entity. Associate entity means its related party investments are not allowed to the fund. Next, the monthly average corpus of the fund should be not less than 100 crore rupees. So every month average with the fund should be at least 100 crore rupees should be raised. At least 100 crore rupees average should be there with the fund every month. But if the fund is incorporated in the current year, then this risk relaxed slightly, and for them monthly limit is not applicable. For them, the government has said that within 12 months you should reach to 100 crore. So in case if you are an existing fund, then monthly corpus should not be less than 100 crore. But if you are a new fund, you should reach to 100 crore till 12 months. Next, if you are wound up in the current year, then this condition is not applicable for you. This condition might be skipped by you. Next, the fund shall not carry on or control any business in India. Fund should not carry on or control any business in India. Next, fund should not be engaged in any activity which constitute business connection in India. Next, the fund should pay proper remuneration to the manager which is prescribed by CBDT. You have to pay proper remuneration to the eligible fund manager which is prescribed by the CBDT. Now there are certain conditions like EFG are not applicable if the fund is managed by or owned by the central government or central bank of a foreign country. So suppose if a Singapore government has this fund, then this EFG condition is not applicable to the eligible fund. Next, what are the conditions to be fulfilled by the eligible fund manager? First of all, fund manager should not be an employee of the fund. It should be an independent person. It should not be employee of the connected person of the fund also. It should be an independent person. Fund manager should be registered as a fund manager. Third, fund manager should work in its ordinary course of business. And fourth, fund manager should not be eligible for more than 20% of the profits of the entire fund. Check it please. Next is, if the central government want, they can exempt any of the condition to certain people. Who is that certain people? If the eligible fund manager is located in IFSC, then central government can exempt any condition for them. So out of the 17 conditions, if the central government want, they can exempt any condition for an eligible fund manager if he is located in IFSC. Now, how will the government come to know whether you are fulfilling all the conditions or not? The eligible investment fund has to fill a statement in prescribed form within 90 days from the end of the financial year. And if the eligible investment fund does not fill this form within the time, then it will be also liable for a penalty of 5 lakh rupees. You can write down over here. 5 lakh rupees penalty will be imposed, which is not very important. That is the reason I have not mentioned this over here. Okay. Now let's come to the next one. That is the master section of TDS, which is applicable for non-residents and foreign company, and that is section 195. Who will deduct TDS under section 195? Any person. The deductor can be any person. It is mentioned over here. The deductor can be resident. The deductor can be non-resident. The deductor can be any person. Further, the deductor may have a place of business or residence or any other presence in India, may not have that. It doesn't matter. The deductor has to deduct the TDS. So whether the deductor is a resident or whether the deductor is a non-resident, it doesn't matter. Whether the deductor has a place of business, place of residence, business connection, any other presence in India, or it does not have all those things, it has to deduct the TDS. Who is deductee? The deductee has to be non-resident and foreign company whose income is chargeable to tax in India. If the deductee's income is not chargeable to tax in India, then you are not liable to deduct TDS under this section. Every time when you are making payment or making credit in the name of the other person, you have to check one very important factor, and that is whether the income is chargeable to tax in the hands of the other person or whether it is not chargeable to tax in the hands of the other person. What is the rate at which the TDS is to be deducted? The TDS is to be deducted at the rates in force, which is mentioned in DTAA or Finance Act, as the case may be, which is not supposed to be remembered by you as a student. Okay. What is the timing of deduction? The timing of deduction is credit or payment, whichever is earlier. Whichever is earlier, you are supposed to deduct the TDS. But in certain case, when interest is payable by government or public sector bank or public financial institution, when interest is payable by these people, then TDS has to be deducted only at the time of payment, not at the time of credit. At the time of credit, TDS is not required to be deducted. Next. In case of 195, in all the cases, whether the other person's income is liable to tax or whether the other person's income is not liable to tax, in both the cases, when you are making payment to a non-resident or a foreign company, you have to fill a prescribed form, form 15CA, 15CB, etc. You have to do that. Without that, you will not be allowed to remit the money, even a single rupee outside India. You have to fill this form, 15CA, 15CB has to be filled, whether or not the income of the other person is chargeable to tax in India or whether it is not chargeable. It doesn't matter. Next. If the other person's entire income is not taxable in India, if the non-resident or foreign company's entire income is not taxable in India, only a proportionate income is taxable in India, then what shall I do? Then in that case, do not deduct TDS on the entire amount. Go to the assessing officer, make an application to the assessing officer, and assessing officer will tell you the proportionate amount, and only on that much amount you are supposed to deduct the TDS. Check it please. The next two case laws talks about one very important factor, that if you are making payment to a non-resident agent and if that agent's income is not taxable in India, the question of disallowance and the question of deduction of TDS does not arise only. The other person's income has to be chargeable to tax in India. In both these cases, you can check it. The non-resident's agent income was not taxable in India. He did not perform any services in India. Therefore, his income cannot be chargeable to tax in India. This is what the Delhi High Court and the Bombay High Court has to say in these two cases. Next is an absolutely new section made by Finance Act 2022. Be very careful. Be very careful. Suppose I am a payer and you are a payee. I am in India. You are a non-resident and foreign company, and there is an agreement between us that I will bear the tax. I will not deduct the tax. I will bear the tax and I borne the tax. I paid the tax also to the government. But after that, I came to know that the other person's income was not liable to tax only. Then tell me please, have I unnecessarily paid the tax and borne the tax from my side? Then in that case, should I get the refund of that tax or not? Again, I am saying, I am a payer, I am in India. You are a non-resident foreign company. There is an agreement between both of us that I will bear the tax. I will not deduct your tax. I will gross up the amount and I will pay the tax from my pocket. Now I paid the tax because it is written in the agreement that the payer will bear the tax. Now after some time I came to know, I paid the tax to the government and then I came to know that the non-resident's income was not liable to tax. So in that case, you will get the refund. Don't worry. You have to go to the assessing officer and you have to make an application within 30 days from the payment of tax. And after that, the AO will pass an order within 6 months. Within 6 months, he will either allow the refund or he will not allow you the refund. If he allows the refund, well and good. If he does not allow you the refund, you can go and appeal to what? CIT appeal. You can go and appeal to CIT appeal under section 246A against the order of the assessing officer. And one last thing which I am dealing for today's session, which will complete the entire non-resident chapter. I hope you all have enjoyed the lecture. And if you have enjoyed the lecture, please comment below so that it encourages more people to watch the lectures and it can reach to maximum students of southern part of India, for whom I am working so hard, especially after recording all the lectures in Hindi. I am again recording all the lectures in Hindi just because you guys are not understanding Hindi. But I have no issue in that. It's okay. It's okay if you don't understand Hindi. It's all okay. There is nothing great in that. It's okay. Now, let's talk about one last thing which is very, very important. That is Rule 115. What is Rule 115? Suppose if any person is earning some income outside India in foreign currency, then how will you convert that in rupees? So how to convert that into rupees? So you have to take TTBR on specified date. You have to take telegraphic transfer buying rate on specified date. What is specified date? Now we have to see the specified date depending upon the source of income. If the income is income from house property or PGBP, other than the PGBP mentioned in this point number 3, it's not point number 2, point number 3, other than the PGBP mentioned in point number 3. So if you are earning what? Income from house property, or if you are earning other than the PGBP mentioned in point number 3, or if you are earning IFOS other than dividend and security, because that is also mentioned in point number 3, you have to convert that as of the last day of the previous year. You have to take which date over here? 31st March 2023 TTBR you have to take and you have to convert. Okay. For income from house property, 31st March 2023. For PGBP, except one income, 31st March 2023. For IFOS, except two income, 31st March 2023. Now, apart from this, every other income, that is salary, interest on security, which is not covered here, PGBP in case of non-resident of shipping business, which was not covered here, or dividend, which was not covered here, or capital gains, which was not covered here, you have to take last day of the month, immediately pressing the month in which the income is accrued. It means you have to take monthly calculation. For example, for the month of April salary, you have to take 31st March ka value. For the month of May salary, you have to take 30th April ka value. For the month of June salary, you have to take 31st May ka value. For the month of December salary, you have to take 30th November ka value. This is how you are supposed to calculate. So I would give you a simple suggestion which everybody can obviously understand. Just remember the first point and the second point is balancing figure. Income from house property, last day. PGBP except non-resident shipping business, last day. And IFOS except dividend and interest on securities, last day. Apart from that, every income will be accrued, will be calculated based on the preceding month ka last day. Preceding month ka last day means monthly calculation have to be done for all these cases. So this is what this great topic, this very big topic is all about. That is your non-resident taxation. Other topic revision videos also I will put as soon as possible. I am trying my best to upload the video as soon as possible, but unfortunately or fortunately, whichever way I will take, Ramzan month is going on. So I am on a fast for the entire day, but still I am recording the lectures in fast. I am not thinking about all those things, but slightly I am tired. So that is the reason I am not making a very big revision video, but I am making first of all the important topics at priority. Okay. Like the next one I'll be making, which will be on transfer pricing and DTAA, etc. because that will be a priority for you to first revise. Okay. So take care all of you. Bye. I hope you all will be doing great in your exams and be confident always. Okay. Take care. Bye. And if you want a copy of this book, it is available on my website, aarishkhan.com. Take care. Bye.